Folks, good morning and welcome to a quick best stock charts for the coming week. You're going to have to bear with me. I had a night of fun and festivities with a couple of buddies of mine. We had a gathering and we finished off probably about a bottle and a quarter of 15-year-old Macallan. So I'm sure they're not feeling all that great today. Neither am I. So it's going to be sitting poolside for the rest of the day. But we will be going live 6 p.m. Eastern Standard Time. For the opening futures action. And what I already sent out to members was the week ahead commentary where we reviewed the charts in greater detail that I'm going to go over right now. So if you're not currently a member, sign up, 14-day free trial offer, get access to that commentary because our strategy is changing and it's changing dramatically. If you watch my best stock charts, if you watch my live streams, I have been warning for a very long time now. Buckle up, we're beginning to break down. Valuations are way too high, earnings are rolling in lower, and margins are being compressed with the 10-year yield and the 30-year yield moving up higher. Something has to give. So we are adopting a more biased short position. We have been neutral with a biased short, but now we're going to become somewhat more bearish on the market on any counter trend rally. So we did have a great week last week. We initially went long in NFLX on a TTM squeeze. I'll show you what that looks like in a moment. That did not play out. It went the opposite direction, and we shorted NFLX, made back that loss, and profited some, and we exited the trade on Friday morning, along with our short of the triple Qs. If you checked in with our Thursday night live stream, I said, if they do, in fact, drop the market on Friday morning, I'm closing out shorts. I'm going to sit on my hands. I'm going to watch to see whether or not they rally the market back or do they drop it into the close and close at or near the lows of the session. They did the latter. Now, meaning they dropped it to the lows of the day. In the final minutes, you saw some buying on the triple Qs. Not aggressive. I could easily see a drop tomorrow morning or a pop-up higher. I'm not quite sure yet. Ideally, they rally the market. Why? Because what we did is we opened up a new position, actually long of Microsoft, by selling premium, selling puts deep out of the money, 10 delta puts. I want them to rally it so that way I could sell twice as many calls on the strangle that we're looking to create. That way we create a ratio strangle. It's a bias short of Microsoft. However, we're not committing lots of capital betting that Microsoft's going to go down right away. All we're doing is that we're selling premium deep out of the money. We're letting time decay work for us. However, we're ratioed to the short side by selling calls. When you sell calls, that's a bearish play. When you buy calls, it's a bullish play. We are the casino, not the gambler. So we're looking to capture premium and time decay. Now, tomorrow, what we're going to be doing is we're going to be booking profits on our strangle of NFLX and quite possibly later in the week, our strangle. Both of these are ratio strangles of Meta. Now, why are we doing that? Well, Friday was 21 days to expiration on the NFLX strangle. So I let it go over the weekend because we'll probably get more time decay on Monday morning, taking into account the weekend. They'll take the weekends out. Same thing holds true for Meta. Next Friday is 21 days to expiration. We want to be very, very mechanical, but I'll probably close out that trade going into the following Monday because, again, they're going to take the weekend out and we want to grab as much of that premium as possible. Why are we being so mechanical and so methodical with our profit taking? We're managing our winners because we do not want to get too close to expiration because that's when bad things can happen. That's when you have a situation where the market is weakening up, a big drop in the market is quite possible. And when you think that you're selling premium deep out of the money 45 days out, you're right. You're far away from the money. However, if you ever take a look at the time decay squeeze or the probability cone on an option, that the probabilities of a challenge to the call side or the put side increase dramatically once you get 21 days to expiration. We don't want any part of that. We've already taken as much time decay out of those trades that we feel comfortable with, and now we're going to look to go widening out new trades 45 days out. Microsoft is one of those trades. Natural gas, we're probably going to be closing out that trade, which didn't work all that well for us because it moved so quickly. Now we're going to go further out on that trade and reestablish and get that position out of trouble. And again, we're managing our trades very, very aggressively out of concern that we are looking at a market that is beginning to buckle up here. So we may get a rally some point in time this week. We're going to take every advantage of that rally by shorting into strength, because we got every reason to believe that this market is ultimately going to get resolved to the downside. How do we know that? We have broken support. In fact, last week on the Triple Qs, we broke down to new lower lows. Join us tonight, 6 p.m. Eastern Standard Time. Hit the notification bell if you want to get notified. I'm going to be talking a lot of technical jargon today on these charts that we're going to be going over. Netflix, Microsoft, Bitcoin or BITO, either one you could trade, FAS, MPC, and CURE. That's a leverage ETF putting you long of healthcare. Healthcare looking really good, relative outperformer last week. So the terminology I'll be using is mostly candlestick charting. Link below, 5-part video tutorial, my top 5 favorite candlestick patterns. Check it out. It's free. All right, let's get to it. I'm going to blow through these relatively quickly, and I'm going to do. I forgot to go over one with members, and that is URA. That is uranium. So members, my apologies. I realized that after I edited the video, I had forgotten one, but we're going to go over it right here, right now. First off, let's begin with uranium. So URA, this is going to be a TTM squeeze. What is a TTM squeeze? I don't even know what it stands for, but John Carter, the trader of Simpler Trading, introduced me to this many, many years ago, and I use it when I want to be in a long trade or a short trade that has explosive potential moves, but I only want to be in it for a couple of days. I do not want to be in positions for an extended period of time hoping that they work out. I want to look for trades that have high probabilities of moving in one direction or the other, and then getting out within a couple of trading days. We want to get that explosive move to the upside or the downside, whichever it takes, and then exit stage right, go to cash, because liquidity is going to be king, especially if this market begins to break south. So let's get to it. What's a TTM squeeze? Basically, to keep it simple, all it is you're taking a look at these lines here. These are your Bollinger Bands, and these are 3 standard deviation. I want to change these to 2 standard deviations. Let's edit this. 2, and we're using TrendSpider, folks. Automated technical analysis. Link below. 35% discount code, and you may even get a better deal because they float a lot of really good deals lately. Just use the link below, and then they have a better deal than our 35% discount code. So check it out. All right, so what's a TTM squeeze? So these are your 2 standard deviations, standard out of the box, Bollinger Bands. And you can see that they are trading within this green zone. Why that's important is that the green zone, these are your Keltner channels. And this is your average true range of where a stock, or in this case, an ETF, generally trades. And what this means is that what we're seeing is a tight consolidation forming, and when you get the Bollingers inside of the Keltners, that means that you're going to probably get an explosive breakout here. Now what you want to do is you want to wait for a close above your 21, your 20 period moving averages, and that sets the stage for a continuation move higher. Now if it starts to move when it's trading down below that 21 or 20-day moving average, that could be a breakdown. I think that uranium is going to break out. So here's what we're looking at here on uranium. Here's our upper band of resistance. I'm not going to challenge this trade to the upside until I see a breakout. So no real difference from what we normally do. We watch for the breakouts when we want to get long, or we watch for unsustainable downtrends when we want to get long. We're just using the TTM squeeze here to identify opportunities. Simple as that. Explosive opportunities. So daily chart of URA looking good here. And when you compare, say, URA relative to, let's go with, I don't know, QQQ, right? We'll just bring up QQQ to show you in general how the Bollinger Bands look relative to the Keltner channels. Here you go, QQQ. And you can see that we have the Bollinger Bands, at least the upper band, outside of the Keltner channel. That's generally where your Bollinger Bands are. But when they're tightening inside that Keltner channel, explosive move, either the upside or the downside. All right, moving on. We have another TTM squeeze here, which is Bitcoin. We're going to go with BITO. This is an ETF, BITO, B-I-T-O. Now, folks, I didn't mention this, but 14-day free trial offer. Please take advantage of it. To the contrarian trader, we send out trade alerts on all of our trades and options trades, which these will generally be. I post the confirmation, or my system posts the confirmation in the Slack forum for you, so you see exactly the structure of the trade. So these are real-life trades. So BITO, another example of the Bollinger Bands in red trading within the Keltner channels. This, to me, is a very explosive potential move up higher. Here's your upper band of resistance, and we're already putting in higher lows. This is sexy because I already get the feel of where we're going to break here. I think it's going to be to the upside. Now, you have a W formation, nice consolidation. Again, higher lows, BITO. It looks as though we're going to have an explosive move higher. The strategy here is going to be using a call spread if we're bullish, a put spread if we're bearish. What is a spread? Let's say a call spread. What are we going to do here? We're going to buy an in the money or slightly out of the money call option, and then simultaneously we are going to buy a call option, and that caps our risk, meaning it's a defined risk trade. We know exactly how much we're going to make, and it's also a high probability trade. So BITO looking good here. What else do we want to talk about? That is a TTM squeeze. FAS, this is a leveraged bank ETF. Again, another example here where you have the Bollingers within the Keltner channels setting up for a possible breakout. You can see I already have my line set up here. I think that this gets resolved to the upside. So while I'm bearish on the market, there are pockets of opportunity. So FAS looking good. If you don't want the volatility, you can always go with, I haven't checked to make sure it's aligned with the XLF, the TTM squeeze, and it is. It's probably even a little bit more tighter than the FAS. I want the volatility, so I'm going to go with the FAS. So you could sell a put spread here. You could do what I mentioned earlier. You could buy a call spread. Either way, one's a very, very defined risk, but very, very defined profit type of trade by selling premium. The other trade is you make a lot more profit, but you do assume a lot more risk, and that's buying a call spread in this case. So XLF, FAS, both looking very good into the new trading week. And I noticed that the KRE, this is the regional bank ETF, was up on Friday. I don't know if you have a TTM squeeze here. You're beginning to. It's not there yet. It's not like the XLF or the FAS, but the regional banks are beginning to consolidate here. So if this market doesn't fall apart and we begin to rally, I think that the banks may take the lead here because they closed up pretty good. Or they should say they didn't close up pretty good. They closed well on a weekly time frame last week. Also, what's looking good on a weekly time frame is when we take a look at the symbol CURE. This is a ETF. Sorry if you're hearing that plane that's flying above. This is an ETF. Now, the markets were down on Friday. What was CURE doing? Bullish key reversal bar, one of my 5 top favorite candlestick patterns. Link below. Take advantage of it because it's free. But the chart I really like here, besides the relative strength that it showed on Friday, was the weekly chart. It broke out. Boom. You gotta love it. So we're going to be looking to trade CURE. We're going to be looking to trade Bitcoin. We're going to be looking to trade, I already own Bitcoin, but we're going to look to add more through BITO because it's a trade. What else do we want to trade here? FAS or XLF. And what else we want to trade here this coming week is Netflix. I think Netflix is going lower. We shorted it last week. We made some money. I did exit. I didn't want to carry it into the weekend. But Netflix is not looking wonderful. Nor is Nvidia, but that's not on our list yet. We may short it, but that's reporting earnings soon. I don't want to get trapped into a position ahead of earnings. But you can see here that Netflix, bearish key reversal bar on the week, stopped at resistance. It looks as though we're going to break lower. And in fact, they broke it down back here. And I talk about this all the time. When you get a breakdown, and what does the market try to do? Traders don't believe in the breakdown. They think the bull rally is going to go on forever, right? So they, rather than getting continuation move lower, you get this. You get a attempted rally in an effort to try to recapture a prior resistance level. And then what happened last week? These guys that were buyers for 2 weeks sequentially and then early on in the week, they got monkey hammered. All right, don't let this be you. The path of least resistance on Netflix is trading. What's the trade here? You could sell out of the money calls, a call spread. You can open up a ratio strangle, meaning sell 2 calls for every 1 put. Many things you could do. You could buy a put spread. Money difference. You could just short the stock if you want to. Our preferred way of trading the Netflix trade is to sell a deep out of the money call spread, or to buy a put spread. And the difference being is the level of risk that you want to put on. If you're highly confident that the trade is going to work in the direction that you want, meaning to the short side, and you want more potential profits, then go with the put spread. The more defined risk, deep out of the money call spread, your probabilities of making money are very, very high, but they're not going to be as great as purchasing the put spread. It all goes back to confidence. All right, so that's the Netflix trade. We have another one here. This is not a TTM trade. It's not a continuation breakdown trade. This is more of an extreme overbought trade, and this is MPC. I'm going to bring you to a daily chart and show you the whys behind we want to get short of MPC. And what I'm going to do here is I'm going to take stochastics off. These are momentum oscillators, or this is a momentum oscillator. My apologies. And you can see that it's flatlined. It's about as overbought as it could possibly get. It's worthless to us right now until it rolls over. What's more important to us is RSI. Now, the RSI, you could see here, is at about 90. It's a little over 90. So what you're looking at here is a very powerful chart, no doubt about it. Can it move up higher? No doubt about it. All right, every time somebody tries to bet against this stock, they get their head ripped off by getting too short. Breakout. Breakout. But we're nearing a level now where this is unsustainable. We're at the upper band of the rising uptrend channel. Can we do a parabolic move up higher? Absolutely. We hope that occurs. And we're looking for rampant buying here, a sign that the retail investor is completely lost their mind. They have no idea what they're doing. And then you're going to get the big institutional money come in, and they're going to dump their shares. But right now, what you're looking at are volume bars that are above average. So we can't go shorting this yet. And the other reason why we can't go shorting it, because besides the volume, besides the fact that we closed at the upper band of the trading range on Friday and closed there, when you take a look at a monthly chart, we are at all-time highs. What does that mean? It means clear blue skies. It means that there are no prior buyers looking to get made whole. So if they short this stock, there's no resistance above. But what you can do is this. You can do what you call an extrapolation. And on a monthly chart, let's take our crayon out and extrapolate using prior resistance levels where there might be new resistance, because guys like me are out there and we're trying to identify a good time to short the stock. And on a monthly time frame, you could see that there are a couple of resistance levels above. We're above one of them at current, but this is a monthly chart, so it doesn't mean it's going to close here. If it continues to move up higher, we can move up to 158, 159 per share. It gets up there. I'm shorting with reckless abandon, especially if that volume on a daily time frame is now dropping off to below average. It means that the institutions are done buying. Now they're going to be looking to dump their position. And the last guy that's going to be buying is Joe Schmo, buying 100 shares of MPC right at the top, and he's going to get annihilated. So this is a great looking chart. It wants to go up higher in the short term anyway. This is not going to end well. So we'll be looking to short MPC. Yes, they do trade options. Is a sale of a call spread on the table for us? Absolutely. I like that trade. But I think the fact that this is trading with a RSI above 90, I'm kind of liking a mixture of both maybe. Maybe I'll sell a deep out of the money call spread, and I'll use that capital to help finance the purchase of a put spread. So I'm kind of liking that scenario. Members, more to come. Folks, don't forget, tonight, 6 p.m. Eastern Standard Time, we're going live. We're going to be talking about the futures action. Remember, it's all about the bond market right now. The bond market is dictating which way this market is going to go. The dollar still very strong. It appears as though it wants to move up higher. It is not time to buy emerging markets. Not time to buy gold yet. There will be a time. But right now, we're looking to lever up on the short side. We're going to continue with selling premium with a bias to the short side. It's working. It's been working for a few months now. And not that we've been ratioed short for a few months. For the past couple of weeks, we have been. We've been selling premium, basically neutral. In the past couple of weeks, we've gone bias skewed short on the market. It worked out really, really well last week. While the markets were down, we banked. Talk to you tonight. Have a great remainder of your Sunday. Be well.